Okay, we're going to talk about provisions and we're going to explain what they are, why they're important, how companies use them, and what the impact is on the accounts for a company of provisions. Now, provision means effectively creating a liability in a set of accounts for problems that we may have in the future. Now, these problems may come from a variety of places, but we have three examples here of very common problems that businesses have that do create liabilities and create provisions. So the first one here, we have maybe a legal action. So someone may be suing you for whatever reason, and we don't really know what will happen to that. Maybe it will go away, maybe there will be a cost. We really are not sure what's happening. But we do need to have money in reserve. We need to provide for that in case we have to pay out in the future. So oh, hi Alex.
Hi.
Right.
I'm not sure, how do we know when to create a provision into the account?
Yeah, okay. So, yeah, that's a good question. Thank you. Well, there is no easy answer to that, truthfully. We need to just be aware of what problems we may face in the future. So it's quite difficult because we don't necessarily know what problems we're going to have next year and what provisions we should have made. So I guess being prudent and being conservative, we try and think about the worst case scenario and then think, okay, if the worst happened, what sort of problems do we have? Can we put money aside for that? So that's where we would make a decision about what provision to make. So we may have a legal case that is obviously could be costly. We may have a warranty for a product and we may find the customers would like to send the product back and therefore we have a cost. We may have bad debts. Now what happens here is customers decide not to pay you. They may have gone bankrupt, they may be in liquidation, they may be potentially fraudsters. We have people ordering product and then perhaps they disappear for some reason. Well, there may be a dispute. We may sort of have an argument about something and then someone won't pay. So in any of those situations, we need to make a provision for bad debts. Okay, let's have a look at this in action. Let's see this working in action. We have a company here and they make a provision of 1% of sales each year. The reason they do that is that they've done research and they found in general, on average, 1% of the customers don't pay. They are bad debts. So that being the case, we need to have money in reserve. We need to have a provision against that potential. These are the customer balances. So I think we can see that maybe 1% of 100,000 is 1,000. And then we could see that would be $900. And that would be $1,200. So these are the size of provisions we need. Basically 1% of the balances. So what I'll do, I'll show you how this works in the accounts, how we actually organize this. Okay, fantastic. So what we have the first year, we need to make a provision of $1,000, and that is entered in the provision for bad debts account. Very logical. And secondly, we need to recognize that as a cost. So we need to put it into a cost account. And that would be something called a bad debt expense account. And that cost then is also reflected in that account. So that goes here. And then finally, at the end of the year, we recognize this cost and we then send it to the profit and loss account as an expense. So we have $1,000 cost in the accounts. Let's do number two. Let's do the second year. We bring the provision down to the next year. And we know now that we only need $900 provision. So how do we organize this? Well, we brought down 1,000. We need 900. We actually have good news. We have a credit here effectively. Well, it's a debit in the provision account. But what we do then is credit the expense account with $100. And that then appears as a reduction in cost in the profit and loss account. We'll do one final one just to see that you can understand what's happening. This year 2, we have a provision of 900. We bring that down to the next year, and we need 1,200. How do we do that? We need another $300. This is a cost. We reflect it in the cost account. And then at the end of the year, all these costs are accumulated, and then they would go as a debit into the profit and loss account as a cost. Now, one final thing to tell you, just be aware of this, that it's the change in the provision, that affects the profit and loss account. This account sits in the balance sheet. This account sits in the profit and loss account. The change hits the profit and loss account. These are the changes that are either costs or income. Good, okay, what we'll do is we'll do a small example here, something similar. And what we have here, we have a company and they have a warranty for their product. So maybe you're buying a electric kettle or something from this company and they say, okay, if you bring it back in 3 years, if it doesn't work, we will give you your money back. So what we need to do is make a provision for that cost, and we say maybe 1% of the sales are returned because the product is broken. So we need to now basically provide for that, and these are the sales. And the provision is 1%, so I've done the calculation. This is the size of the provision. And now what I'm going to do is ask Alex to come up, please, and explain what is the cost of this, the change of these provisions.
Okay, so the first year, there's an increase in the liability here. So it'll be 5,000, will cost of 5,000. And on the third year decrease, so it'll be an income of 6,000, I think.
Okay, so we started with $10,000 and then we had to increase our provision. So we increased it $5,000. And absolutely right, thank you, Alex. So we've got a cost of $5,000 here. So that's spot on. Bad news, $5,000. Now the next year we have some good news. The provision reduces to 9,000. And therefore, in that case, we have effectively a credit or income of $6,000. So we have some good news here. So bad news and good news. So the profit and loss account reflects the change in the provision, not the actual provision, So fantastic. Thank you, Alex, for doing that.